Welcome, everyone, to the Loan Officer Training Series with the Mortgage Calculator. We will wait just a couple of minutes to go live, and you can drop a comment in the chat. In the meantime, we do have the chat up there on the screen, so feel free to drop a comment there. I see a lot of people were already commenting there. Ben, Adam, Chrisita, Sky, Olive, Mark, Jerry, Pearl, Orlando. Tons of people already commented. That's awesome. Thank you guys for tuning in nice and early. We'll get started here in just a moment. Remember, we do this loan officer training every Tuesday and Wednesday night at 7 p.m. Eastern. So also make sure to tune in tomorrow as well as every Tuesday and Wednesday evening. We got a great topic for tonight, something that we are very excited about here at the Mortgage Calculator and deal with on a daily basis. So we'll be getting into that here shortly. In the meantime, feel free to drop a comment there in the chat while we wait to go live on all the different platforms. Hope everybody had a great holiday weekend and is ready to get back to it. We'll get started here in just a second. All right, it looks like we are live on all the different platforms, so we can go ahead and get started. Let's go ahead and take the chat off the screen then, and we will get into it. So, welcome everyone. My name is Kyle Hershey. I am the COO of the Mortgage Calculator, joined here by our president, Nick Hershey, and our sales manager with 27 years of experience, Jose Gonzalez. We do this show, the Loan Officer Training Series, every Tuesday and Wednesday night at 7 p.m. Eastern, where we go over different topics for loan officers. And today's topic is going to be working with short-term rental property investors. Now, we're also going to do part 2 of this tomorrow, which is going to be structuring short-term rental loans. But today we're going to go through how it is and what it's like to work with short-term rental property investors. So what we'll do is Jose will go into a little presentation here shortly. But before that, I will have Nick just talk a little bit about working with short-term rental property investors. Nick is a good person to have some insight into it because when he was a loan officer, he dealt with plenty of short-term rental investors, and he is a pretty prolific short-term rental investor himself. So, Nick, let's go ahead and talk about the topic here today.
Sure. So it's definitely a hot topic now. When we first started doing DSCR loans, and many of our customers were actually doing short-term rentals, obviously we would not have an option to use the short-term rental income, which is a lot of what Jose is going to talk about probably tomorrow, of actually executing these deals. But I would say the number one piece of advice going in here for someone that's new to this is to understand that we don't need to focus on short-term rental income to execute one of these loans. So as long as the long-term rental income works, they work just fine. So for the past 2-3 years, before we even had the option to use short-term rental income, we've been very successful doing these loans without even mentioning the word short-term rental income because it didn't exist in these loan programs. So right now, we're fortunate enough that these loan programs have opened up to allow us more options to use short-term rents and, have these discussions with the borrowers about what a property is and what it isn't exactly. Obviously, the investors, the banks, the end users of the loans have become hip to the idea of short-term rentals being used for specifically a lot of these non-QM loans. They've also become hip to it on conventional loans, right? So be careful doing conventional loans short-term rental. Obviously, there's things you can do and things you can't do. So because it's been a gray area in the past, we're trying to kind of box it in and fit it in a box here now. And non-QM, fortunately, has really opened up the box for us and allowed us not only to define what it is for a short-term rental versus a long-term rental, but give us the options to use that income when we need it, especially with this higher rate environment where long-term rents may not meet the DSCR or even sometimes a full doc income that we need if the rents come in really low that is unexpected, or the payment's high, in this case with the high rates, where the rent hasn't gone up in at the same pace as all the rest of the economics here. So a lot of things going on here when we have these conversations. I would say the biggest thing is don't stress about what the short-term rent is and what the long-term rent is. We need to know it, of course. That's what Jose is going to go over. But just understand that we can do both. We just need to know what we have, and then we can kind of put together a plan for what we can attack it with. So that will be more of kind of what we need to gather is just relax, gather information here in the first part, and then tomorrow Jose will go into how to attack with that info. And option one, don't say anything about the short-term rental income, and we can use long-term rents for a lot of these programs. Or option two, if we have to use short-term rent, we need to know where, how that works, what our limits are, does that affect our LTV, all that kind of stuff. So we'll go into that tomorrow. Today, Jose is going to go into some basics on how to kind of put this together. But I just wanted to kind of introduce the topic and say that we're going to talk about short-term rent, but it doesn't mean that we have to execute a loan that only has that option, right? This is just one flavor of loan that we can do. If you're doing a short-term rental property, there's a ton of different options, and there's one that's very specific for it. So I guess with that intro, Jose, if you're ready to do your thing, let's go ahead and have you take over.
Yes, I am. I am ready to share my presentation here and enlighten our team and those out there listening, our audience, on how you can navigate these waters. You did bring up some very good points, and that is do not put on the blinders and assume that the property is only a short term rental property if it is being purchased by someone who has not been doing short term rental properties on the property, right? I mean, if you're doing a refi and you're doing short term rentals, obviously it's a short term rental property. If you're buying a property that's possibly vacant, and you're going to be going off of a lot of different ways to factor out the income, then it's you're buying the property and you may not have any issues. But let me not jump the gun and let me cover some of these things in a bit of a detail here so we can understand what we're talking about. But first and foremost, what is a short-term rental property? Because there's a lot of misconceptions out there about what it is and about what it isn't. So basically, we're talking about a property that can legally be rented by the day, week, month, or any other period that is less than 6 months and 1 day. Because for most municipalities, counties, states, and other governing bodies that are going to govern what you can or can't do with your property, 6 months and 1 day is usually the time frame that is considered long term. Anything shorter than that would be considered short term, in which case there are additional filing requirements for like hotel tax and other tourist tax and other things like that, right? So that's really important. Now, for our case here, when we're talking short term, we're not really going to be just looking at 6 months and 1 day. We're going to be looking at, short term rental a la Airbnb, VRBO, Home Away, and these other platforms that basically allow the owners or property managers to advertise their properties on those platforms for rent like a hotel, right? We're talking daily, weekly, weekend, really short term periods of time. Now, these properties don't necessarily have to be professionally managed. That's totally up to the option of the borrower. There's a flexibility on that. Now, mind you, sometimes they may be buying a property that is in a designated like short-term rental or condo hotel or something like that. That's something you really have to be aware of and pay close attention to, because there are additional restrictions for properties that are indeed restricted communities that do not allow long-term rentals. If it's a true short-term rental community, that's something you have to be aware of, because that will come up in the loan structure and that'll definitely throw you a curveball as far as LTV. Okay, so
What
that
about
is
the condo hotel there, Jose? You said it
well,
once. Can you define that a little better? Because that
yeah,
that that could trip some people up here.
yeah, totally. Well, a condo hotel is going to have certain designated components to it that make it strictly only short term, right? Usually, true condo hotels do not allow permanent occupancy by the owner of the property on a long term basis. They usually have maximum term limitations that you can stay for any continuous period. Sometimes they'll say 6 months, sometimes it's 1 month continuous. It really depends what it is, but there are deed restrictions that will definitely impede financing in the regular sense. That's why we have those, non-warrantable condo loans and condo hotels, commonly referred to as condotels, fall into that category because they also have a lot of other restrictions. A lot of times they limit on who can actually manage the property. A lot of times it has to be managed by them, being by the actual condo and not by the owner or a property manager of the owner's choosing. So don't lump all short term rental properties into one bucket because it's very different if you're talking about a condo hotel versus a condo that may legally allow short term rentals, but is not a condo hotel with all of the extra restrictions that a condo hotel has, including just being able to get financing for above 70% LTV is going to be a challenge for a
So,
hotel.
so moral of the story here: we're not even talking about condo hotels. We're talking about the the larger subsection of short-term rentals. If you get into that condo hotel, just know that there's problems there. Not necessarily problems that you can't solve, but obviously there's going to be other things there that limit you on LTVs besides just what we're going to talk about today. So if you start going into condo hotel land or non-warrantable condo land, be super careful. That's a great point there, Jose. But that's not what we're talking about today.
Right. I just exactly. That's why I want to clear the air on what we are and what we aren't talking about because it's very easy to go
Mixed
down
up.
that rabbit
Yeah,
hole and not come out with a condo hotel. That's a very small subsection of the lending
exactly.
market and definitely not what we're talking about in our example here. Now, I do stress the part where we mentioned legally. That can be legally. Why do I say that? Because there may be a lot of cases where a borrower may be buying a condominium to do short term rentals, and the condo may not allow short term rentals in their bylaws. You're not going to be able to close on that. And if it does close, it could have a serious problem for the borrower if they're doing it illegally and the association finds out. They could basically hit them with some fines, cease and desist orders, and now they're going to have to be dealing with just a long-term rent. So when you are consulting your borrowers with these loans and they are bringing up to you their desire maybe to do it in a condo, just make sure that you tell them to coordinate it with their real estate agent very well to confirm that there are not any restrictions that do not allow it. For a condo, that would be a mortal blow. Now, second home loans, like Nick was mentioning in the conventional world, second home loans do allow for properties to be rented short term without a lease when the borrowers are not staying there. However, that would be more of a seasonal, sporadic kind of. When I'm not there, I'll rent it out, but when I'm there, I won't rent it out. But that's not really what we're talking about here when we're looking at the person that's just looking at this as pure investment. Probably not ever going to stay there, in their life. Maybe they may stay there one day, but if we're going to be structuring DSCR loans, which we're going to get into, those are for investment property only. So when you are consulting your borrower, figuring out the structure, you really have to be clear to find out from them what is the expected occupancy because you don't want to be structuring them into a loan that could end up later on in some kind of a misuse of the property by them and possibly cause them to be foreclosed upon for doing something illegal in the property that they're not supposed to be doing. So keep in mind, very important to know that there are avenues for that, but definitely would not be the most of the avenues we're going to discuss now. Some may be applicable because some are more obvious than you think, right? But before we can get into options and what can we do, what are some of the potential issues besides what occupancy that we just mentioned right now that that a that an owner could face? Well, if you're buying this property or if it's a refi, it could be more of an issue where if it's a vacant property, in some cases, it may affect the LTV. This is a lot more prevalent when it's a refinance for sure than when it's a purchase. It's a purchase, you can usually buy a vacant property, but this is the very important point that Nick was mentioning about what is the intended use and how do we navigate the waters so that we don't just blow it from the beginning, right? There's a lot of things that we can do, a lot of ways we can structure it before we go about trying to structure a vacant property loan or a true short term rental property loan, where now you are immediately restricting yourself from doing a lot of things. And I'll get into that when we talk in the next slide. But a lot of things to consider here. Now, you may have a property that may have a high cost compared to the projected long term rental income, what we like to call our trophy properties, right? Amazing property could be on the base of a ski lift. I mean, this thing is gonna just get $2,000 a night short term rent, but long term rent maybe it's 2,800 or some other really ridiculous number because hardly nobody uses it for long term rent because they're only used for short term. So there could be a lot of reasons. Or conversely, you may have a scarcity of short term rental comps in an area where your future short term rental operator borrower says, "Oh no, man, I did my research. That's gonna be amazing short term rent because nobody's doing it around there. I'm gonna corner the market." Yes, that is true. That could work out that way, but now you have a scarcity of short term rental comps, which could affect some of the options that we're going to choose, which you'll see in a minute what I'm talking about. Or you could have an investor with limited or no short term rental experience. That's a definite issue in some of these cases because they're not going to necessarily let you use some of the short term rental comps in some cases with a borrower that does not have the experience. That's why in some of these cases they'll ask for like a 12-month revenue report, and it's not just to get an average of a year, it's also to show that the borrower has been doing it for a year, that they have experience. So that's not the case in every option, but that is the case in some of the options. So when you are looking in the guidelines, you have to be aware of what you're looking for, potential pitfalls, so you don't get all excited just because the first few lines sound good. That's the option we're going to go with, and then you didn't read the end where it gave the disclaimers on what could or couldn't basically disqualify from using that option. So these are just some of the potential issues. There are many potential issues to be aware of, but it's all about being aware, right? So now this is where I told you some of the options could be a lot more obvious than you think, right? Don't just go straight to think the only way that I can do this is to go, let's say, DSCR, because your borrower may be able to qualify full doc with minimal or no income from the property, so they can use any applicable lending program that is just based on their credit and income. This is especially true for bank statement programs or profit and loss programs or asset depletion programs. You could have a borrower barely making it on a or not making it on a full doc, barely trying to squeeze it in on a bank statement, but on a P&L, they're flying high. They're super low DTI. So, don't assume anything. Don't trap yourself by the assumptions. First, see what the data is, see what you have available to work with first, because it could simply be that a profit and loss could work. I mean, I'm doing that right now on a loan that we were trying to go bank statement, we were trying to push the envelope, so to speak, but then we realized that for the same cost at this investor, uh, profit and loss was an option. So we just had to do some additional structuring from the accountant to get the documents that we needed in order to have a super clean file. So before you go down that deep short-term rental rabbit hole and complicate your life, see what other options may actually be available for you. Because remember, we always have to go with the lowest cost option first and then work our way down to higher cost options, right? So I just want to always be creating that awareness. But with that being said, most of the time, what ends up happening on our short term rental loans is that we end up going with our debt service coverage ratio option. Now, this is really where at the mortgage calculator we have been able to shine, because we have so many different debt service coverage ratio options. We have been mastering the DSCR loans now for a few years and have really learned how to navigate those waters very effectively, using all the little nuances for the DSCR loans in our favor when structuring short term rental loans, right? If the numbers add up, like Nick mentioned earlier, if the numbers add up, then we really do not need to worry about short term rents, right? I mean, if you got a property that on the long term rent is going to work for you. And again, this is all a holistic approach, looking at the expectations that your borrower has with loan to value, right? Now, obviously, they usually want 85% or the max loan to value for an investment property, which is usually going to be 85%. So we try always to work that angle. We have our 85% LTV DSCR, right? If the long term rent adds up and our DSCR is 1.25 or above, we got a deal. The application is put through as long term rents. It is what it is. It's an investment property, and that's it. You don't have to complicate yourself with any extra business narrative on what's going to happen or anything. Long term rent, the numbers add up, we're good to go, right? Especially if it's a vacant property with no existing lease, that's even better, because then you don't have to worry about the restrictions of having a tenant in there at $1,800 a month when you're going to get $4,800 a month on through your short-term rent. But this is for the ideal scenario when the long-term rents work. It could be a 1.5 DSCR or a 1.25 or 1.0. Now, to refresh everybody's memory on what the debt service coverage ratio is and how it is established, it is the total rent for the property, the monthly rent, grow, whether it's in this case, let's assume it's from a market rent schedule provided by the appraiser. So it is simply that number divided by the total housing expense: principal, interest, taxes, insurance, and if applicable, mortgage insurance. Right? It was not going to be applicable in this case, but excuse me, if applicable, association fees, what I meant to say. So if your DSCR is 1.5 or greater, awesome. 1.25, awesome. That means it's covering 125% of the housing expenses, covering 125% of the rent, or the rent's covering 120% of the housing expense, or it's covering 100% or 150%. But where it's covering less than 1.0, this is where we really can use the DSCR program to our advantage on these situations, because typically, depending on the credit score we may be able to go 75% for a DSCR above. Typically, if they're like point 0.8, 0.85 or above, we have options at 75% or above. And then usually the options below are going to be 70% LTV, or going to be the more common options for 0.75 to 0.99 and less than 0.75 DSCR. But mind you, now one is 70% and the other is 75%. And a lot of times in the short term rental options, there is an LTV adjustment of 5%. Not in every option, but in most of the options, definitely the ones using AirDNA, they hit you with a 5% LTV reduction. So you're already going to have issues there with that. So study the numbers very well, and you're going to see in a majority of the cases you will be able to do it with the DSCR structure, as long as you have set the proper expectations from the beginning with your borrower. Right, you have to properly explain everything, empower them, let them know what the challenges are, what the pitfalls are, so that they are aware that at a 70%, it's going to be a great rate and a great loan. At a 75, it's going to be a great rate and a great loan as well. In some of these cases just may not be possible to reach the higher numbers. But again, these are when long-term rents will allow you to meet the objective within the expectations of the borrower, and that is always key. Now, in some cases, their expectations may be great, but the budget just doesn't permit it, doesn't allow, going to the 70%. So, we still have options here, but we take them in a certain order. So we do have short-term rental specific options, right? Like the ones that I was mentioning that may have a 5% LTV reduction. For example, the one this is like the unicorn, right? When we're using the AirDNA database to arrive at our short-term rental projected income, right? Keep in mind, AirDNA is for purchases only. It's not going to be for a refi, because on a refi, they want you to provide activity for the last 12 months that you've been doing it, unless you can get actual short-term rental comps to be put in there by the appraiser. Then they don't require 12 months. So we do have options that will, if the appraiser puts it in as a short-term rental comp, which I've had them do that, then no 12 months is required. But if you're using revenue reports, then you have to go with the 12 months. So AirDNA does have a 5% LTV reduction. The short-term revenue reports do not necessarily have a 5%. We have options that allow you to use it without an LTV reduction. So you can be at an 80% LTV using short-term rental revenue reports. Right now, we do have an option where if it's a purchase and the seller is willing to provide it because they were doing short-term rent on the property for the last 12 months and they're willing to disclose that information, then we can use it, and we can use that to help qualify the borrower using the revenue reports. Right. So again, when you're looking at the guidelines, look well, because you may have three options that look the same, allowing you to use short-term rental revenue reports, but one may require the 12 months of experience and the other may not require the 12 months of experience, just require 12 months of reports uh, based on what that actual property has generated. So again, you got to look deep into the guidelines. I mentioned also if the appraiser can actually provide short-term rental comps. They're actually like in the multiple listing and stuff like that, where there are comparables, where they're doing weekly rentals, monthly rentals, in areas that are popular for tourism. You're going to find that in the multiple listing database. That's fine. And what you do have to keep in mind that all of these options are going to be subject to what we call a haircut. In other words, they'll probably reduce the gross revenue amount that you arrive at after doing your averages, they'll probably reduce that by anywhere from 25 to 30%. So you have to review the actual guideline to see what they're going to do, right? So different short-term rental options. You've heard these phrases: Air DNA, short-term rental revenue reports, or actual comparables put on the 1007 by the appraiser. That's the real unicorn there. Having the appraiser find the short-term rental comps and put them on the 1007, but it is possible every now and then, right? So, but what you're going to find a lot of times is that what they're going to tell you is that all they're willing to do is do a narrative report, which the narrative is going to be they'll use long-term rent comps on the actual 1007, and then they'll provide an additional narrative on that same 1007 of the reports that you provided them with, right? So that's usually the extent of what they'll do. And on the Air DNA, a lot of times the investor or underwriter will require that they run the Air DNA report themselves.
Jose,
So yes.
real quick, talk about the haircut, because that's the most important part. Remember, if we're using short-term rents, we're always going to get a reduction. Why are they doing that? Just so everybody understands.
They know that there'll usually be some type of a management fee and
And a
other
cleaning
and,
fee
yeah,
every rental, right?
and other expenses that they know. So since they're not asking us for a Schedule E, right? There's no Schedule E that's going to be provided of income and expense, right? We're only providing part of it. We're providing the income, but not the expense. So they're throwing in there uh, the uh, the expense ratio. Could be 25 or it could be 30%, depending
And
on where you
remember,
send it.
short-term rental property management is typically double or triple the cost of a long-term, so they're going to give you, the benefit of the doubt in their favor, obviously, right? That they're going to
Yep.
assume you're going to use a top-end management, which you're going to need. It's going to be expensive to operate a short-term if you haven't done it before, so they're going to make sure that they adjust that accordingly.
Yep. So again, many options there, but like I was saying, guidelines are all different, right? So that's why when you are looking into, going deep down into the guidelines, please read them all the way through. If you have any questions, reach out to us, reach out whoever you need to reach out to for clarifications to make sure that you aren't missing some of those important points, those little extra little conditions that have to be met that could disqualify your deal.
All right. I don't see any questions here, but definitely great there. I think it really boils down to, in the end, the analysis, right, Jose, of, coming into this is not just skip straight to DSCR, short-term rentals, right? This is, could this be a second home? Could this be a full dock investment property? Could this be a DSCR that we're going just based on the long term, which is really ideal if we're going to do a DSCR, or is this something that's going to require us to dig into the actual short-term rental, whether it be the Air DNA or on the 1007, right? So it really all starts at the proper interview of the borrower and analysis of the situation, right?
Yes, sir.
We got a couple questions here. Let's go through these real quick, Kyle, before we wrap it up. So Ben was asking, will the appraisal give us both short and long term? That's a good question, because they won't, right?
Right. Yep. They will not. That's what we were mentioning when I was talking about right now at the very end. They usually, that's what I was saying, having them provide actual short-term rental comps on the 1007 is the unicorn, because normally they won't do that. They will provide long-term rental comps only, usually, not always, but usually only long-term rental comps. And if push comes to shove and you provide them the information, they will include the short-term rental comps as a narrative. It's very difficult to get them to provide short-term rental comps on the 1007.
All right. And Jose got a shout out from a customer. Do we do construction to permanent?
Yes, how you doing there, Freddie? We definitely do construction to permanent. We do that for multifamily properties as well, commercial properties as well as residential properties. We do ground up construction where it's simply an investment property construction loan that then is either the property is going to get sold or is going to get converted into a rental property, in which case we refinance the construction loan into the end loan. What we do for primary and second home loans is called the one-time close loan, which is super cool. That's a construction loan which then transitions to the end loan, their final 30-year loan. So since from the initial closing, they're paying the interest rate on the end loan, which is much lower than a regular construction loan. It allows them to manage the project and basically it's just like the program says, you only close one time, you save closing costs, and you guarantee the rate that you're going to get in a year now. So that's a really good option for those.
All right, we got customers tuning in too. And then Jason, one of our team members, had a question. For the appraisal, are the values still going comps? Are the values based on income the property gets? We're not going to use the income approach, are we here, Jose? We're still doing
Nope.
a standard valuation.
Yep. Even though we do have a debt service coverage ratio component, which is a trait from the commercial world, we are not doing a true commercial appraisal, which would value the property based on the cap rate. We're not valuing the property based on the cap rate, which is the percentage rate of return on investment and all that kind of stuff. We are I mean, there's a DSCR, which is what the loan is the borrower is being qualified for as far as income, but the property still is going to be valued based on the market approach, the comparable market sales.
Good questions there. I think that's it for questions.
Perfect.
So you can wrap it up.
All right, cool. Well, again, we are going to do part 2 of this tomorrow, where we will actually go into some different scenarios and stuff. So great setup here, Jose. Great information. We'll continue it tomorrow with some actual scenarios and talk about actually doing some of these short-term rental loans. So make sure you tune in tomorrow and tune in every Tuesday and Wednesday evening at 7 p.m. Eastern time. So thank you, everybody, for tuning in. Thank you, Nick. Thank you, Jose. We will see you tomorrow for the next episode of the Loan Officer Training Series with the Mortgage Calculator. Everyone have a great night.
Thank you, everybody. Good night.
Thanks, everybody.